Has Celsius's meteoric rise from, a niche player to a billion-dollar brand actually created a sustainable beverage giant? Or is all that high-octane growth about to, well, run out of fizz? We've crunched the numbers, and honestly, the evidence suggests that while Celsius makes a really popular product, the stock itself, it looks at best fully valued, with a risk-reward profile that seems skewed to the downside. Today, we're doing a deep dive into Celsius Holdings, Inc., that's traded on the NASDAQ, ticker CELH. And just so you know, our analysis is anchored to July 20, 2025, with a reference share price of $44.43. Our mission here is pretty straightforward. Dissect the company's business, its management, the financials, the risks, basically help you understand what's truly important, the core insights, maybe some surprising facts behind all those numbers.
Exactly. And we'll be looking at this through a disciplined lens, really connecting the dots so you can see not just what's happening, but crucially why it matters and what critical questions this whole situation raises for any investor or really anyone just curious about the market.
Okay, let's kick things off then with Chapter 1, Business Analysis. So Celsius Holdings operates on what's often called an asset-light business model. What does that mean?
Well, it basically means they don't own the factories. They outsource manufacturing and packaging to third-party co-packers.
Right. And why is that important, you ask? Well, it dramatically minimizes their capital expenditures, those big upfront costs for building factories.
Keeps their fixed costs low, gives them operational flexibility. It's actually been pretty key to how fast they've been able to scale up.
Definitely. Now, how do they actually make money? Their revenue comes from a multi-channel sales and distribution strategy. And the absolute cornerstone here, you have to understand this, is their strategic distribution agreement with PepsiCo, signed back in 2022.
Mm-hmm. PepsiCo's direct store delivery system, the DSD system, it's massive.
Huge. Think about all those Pepsi trucks you see delivering right to the stores. This system is critical for Celsius. It accounted for, get this, 59.4% of Celsius's total revenue in 2023, almost 60%.
Wow, that's heavy reliance.
It really is. Beyond that, they do have direct partnerships with big retailers like Walmart and Target. They also sell through e-commerce and direct-to-consumer, DTC, platforms like Amazon, Instacart, and their own website, Celsius.com.
And that channel, the DTC one, tends to be higher margin for them, right?
Exactly. Made up about 9.7% of 2023 revenue. And then finally, they strategically target specialty channels, fitness clubs, gyms, GNC, the vitamin shop, places that reinforce that brand identity. Oh, and a smaller stream from licensing and partnerships, too.
Got it. So multiple channels, but PepsiCo is clearly the main artery.
No question. Now, diving into their key products, the master brand is, of course, Celsius. It's positioned as this premium, functional lifestyle energy drink. Its core appeal, that better-for-you, zero-sugar formulation.
Within that, they had sub-brands.
Yeah, things like Celsius Originals, Vibe, and Essentials. But here's a major development, really game-changing. The acquisition of Alani Nuth. That closed April 1st, 2025.
Ah, yes. The big acquisition.
Huge. And this isn't just like another flavor. It adds a second distinct billion-dollar brand to their portfolio. Alani Nu focuses specifically on a female demographic, so it significantly expands their market reach.
Interesting. So diversification through acquisition.
Pretty much.
Yeah.
They also have some alternative formats like on-the-go powdered stick packets and Celsius Hydration. Okay, so market position and scale. Celsius has successfully climbed to the number 3 market share spot in the U.S. energy drink market as of the first quarter of 2025.
Number 3 is impressive, given the giants they're up against.
It is. The Celsius brand family alone had a 10.9% dollar share. But if you combine it looking at what they call pro forma share, which basically means as if the Alani New deal happened earlier, it brings their combined potential share to a pretty significant 16.2%.
16%. Like
Financially, they crossed the $1.3 billion annual revenue mark in both 2023 and 2024, which sounds huge, right?
it's big growth, yeah.
But you have to put it in context. They're still considerably smaller than, say, Monster Beverage at nearly $7.5 billion, or PepsiCo's beverage division, which is over $90 billion. So perspective is key.
Right. Still a smaller fish in a very big pond.
Exactly. Their primary value proposition, what they hang their hat on, revolves around this live fit brand ethos. They market it as a better-for-you, zero-sugar alternative to the traditional energy drinks.
And they push the functional claims. Metabolism, energy.
Yeah, exactly. They emphasize ingredients like green tea extract, and importantly, no artificial preservatives, no aspartame, no high fructose corn syrup. That really helps differentiate them from some of the older players.
Got it. The healthy angle.
Right. Now, let's zoom out a bit to the industry itself. Celsius operates in a massive and growing global energy drink market. Projections show it going from about $73 billion this year, 2025, to over $97 billion by 2029.
Wow, that's a pretty healthy growth rate. What's driving that?
It's a few things. Increasing demand for health and wellness products, constant flavor innovation, the rise of e-commerce, and this trend called functional blurring.
Functional blurring, meaning drinks that do more than one thing.
Exactly. Like an energy drink that also hydrates or maybe helps with focus. The lines are blurring,
Makes sense.
but the competitive landscape, it's incredibly intense, dominated by Red Bull and Monster, obviously, plus the huge beverage conglomerates like PepsiCo and Coca-Cola.
And it's interesting that complexity where PepsiCo is both their biggest partner and a major competitor.
It really is. And you also have this continuous stream of new emerging brands popping up because, believe it or not, the actual production barriers are relatively low if you use co-packers.
Right, anyone can mix up a drink. Getting it on shelves is the hard part.
Precisely. And speaking of challenges, the regulatory environment is seeing more scrutiny globally. Things like caffeine levels, sugar content, marketing to teenagers. That could mean stricter labeling, marketing limits, maybe even special taxes down the road.
Definitely a risk factor for the whole industry.
For sure. So back to barriers to entry. Production barriers, low. But the real hurdles are distribution, getting it everywhere, and building a strong brand that people recognize and trust.
And this is where that PepsiCo partnership comes back in, right?
Absolutely. It's arguably their most significant competitive advantage. That deal is the primary protective wall, the moat, against smaller brands trying to get shelf space. So competitive advantages. Brand strength is key. That live fit identity resonates with health-conscious consumers. And the Alani Nu deal strengthens and diversifies that brand portfolio.
And you mentioned cost advantages starting to emerge.
Yeah, they're seeing some economies of scale. Their gross margin, that's the profit on each can before overhead, expanded from 48% in 2023 to over 52% in Q1 2025. They say it's due to better sourcing and lower freight costs.
That's a good sign. Shows some operational leverage building.
It is, but again, context matters. Their overall scale is still dwarfed by the big guys.
True.
Now, what about network effects or switching costs? In the beverage industry, switching costs for consumers are exceptionally low.
Yeah, it's super easy to just grab a different can off the shelf.
Exactly. Brand loyalty is fickle. It means Celsius has to constantly invest in marketing just to keep people buying their product. It's not like, say, enterprise software where switching is a nightmare.
Right. Every sale is a new battle.
Totally. So, unique assets. We keep coming back to it. The PepsiCo distribution agreement. That's the crown jewel. It even included a $550 million investment from PepsiCo. Unparalleled scale and reach.
Solves the biggest barrier to entry.
It does. They also have proprietary formulations, patents. That's a good marketing angle, but how defensible those are long term?
Right.
It's debatable.
Yeah, and this actually raises a really important question. What's fascinating here is how that very reliance on the PepsiCo partnership, while it's a clear moat against small players, also presents a strategic vulnerability.
How so?
Well, recent reports show Celsius's growth figures are directly linked to things like PepsiCo's inventory correction actions, and even just the timing of orders.
So Celsius's results can swing based on what PepsiCo decides to order or when?
Precisely. It makes their performance highly susceptible to decisions made by their largest customer, who, let's not forget, is also a competitor in the broader beverage space.
That's a tricky position to be in.
And if we connect this to the bigger picture, that better-for-you moat, it's pretty permeable. I mean, look at Alani Nu's rapid success. Celsius basically had to buy them to get that growth and demographic.
Good point.
It really suggests Celsius's competitive advantage isn't some deep structural thing. It's something that requires constant, heavy reinvestment in marketing and innovation just to stay ahead. It changes the economics, doesn't it?
It absolutely does. So their edge isn't locked in. It's something they have to perpetually earn through spending. That really does change the picture. Okay, let's pivot now into Chapter 2. Management evaluation. Leading the charge at Celsius is Chairman and CEO John Fieldly. He's been with the company since 2012, started as CFO, became CEO in 2018. And you have to give him credit. He's overseen explosive growth from $53 million in 2018 revenue to $1.36 billion in 2024.
That's a huge jump. A remarkable growth story under his watch.
It is. However, his tenure isn't without let's call them blemishes, there was that very high-profile Florida lawsuit.
Right, that ended up costing them a lot.
Yeah, an $82.6 million judgment against Celsius back in January 2023, and it was upheld in December 2024. That highlights potential weaknesses in, contract management, legal risk assessment.
Not ideal.
And there's ongoing litigation, too, derivative actions against executives and directors, alleging false or misleading statements about growth and that crucial PepsiCo agreement. It kind of casts a shadow on governance.
So some legal clouds hanging over them.
Definitely. And in response to the recent growth slowdown, management's big move was that very costly $1.8 billion Alani Nu acquisition.
Seen by some as a decisive response, but also perhaps as buying growth.
Exactly. Which leads into communication and reputation. Celsius uses the standard channels, SEC filings, earnings calls, investor presentations.
Pretty standard stuff.
But those ongoing lawsuits about potentially misleading statements, they definitely introduce reputational risk and suggest maybe a gap between the public story and the operational reality.
Perception versus reality can be a killer for stock prices.
For sure. Now, let's talk capital allocation, how management spends the company's money. Their clear priority has been reinvestment for growth, marketing, R&D, international expansion, not returning cash to shareholders yet.
And the biggest allocation by far was that Alani Nu deal.
$1.8 billion cash and stock. Closed April 2025. The stated reason, to create a leading, better-for-you functional lifestyle platform. And they projected $50 million in synergies, cost savings from combining operations. But here's where it gets really interesting, as you hinted, the timing. This massive deal happened precisely when the core Celsius brand's organic growth just stalled dramatically.
Right, which fuels that interpretation that management might be buying growth to mask a slowdown.
Couldn't you argue, though, that even if it looks like buying growth, it's also strategically smart? Diversifying, capturing that female demographic with Alani Nu, isn't that a good long-term play?
That's the counter-argument, and it's a valid point. Diversifying with a proven brand like Alani Nu, especially if they can push it through PepsiCo's network, is strategically sound. It expands their total market.
Okay.
However, the sheer size, $1.8 billion, right when organic growth hit a wall, it raises serious questions about the price they paid. Was it disciplined? It shifted the narrative from pure organic success to growth via acquisition. And that carries the risk of a roll-up strategy, acquiring companies, maybe at expensive prices, just to keep the top-line revenue number going up.
That makes sense. A fine line between smart diversification and potentially overpaying just to keep the growth story alive. Okay, so what about returning capital to shareholders? Buybacks? Dividends?
Nope. No dividend and no history of share repurchases either. All earnings are currently retained for growth. And what's particularly fascinating here is that despite pretty significant stock volatility, the share price swung from a high of $96 down to a low of $21.10. Management chose to spend $1.8 billion on an acquisition instead of buying back their own stock, even when it was much cheaper.
That's a good point. What does that signal to you?
Well, it subtly suggests they perhaps didn't believe their own stock was materially undervalued, even at those lower prices. Otherwise, why not buy your own shares back at a discount?
Interesting perspective. Okay, last management point. Return on invested capital, ROIC. This basically measures how well they're using the money invested in the business to generate profit.
A key metric for efficiency.
Celsius's ROIC over the last year, the trailing 12 months, is around 11%. Now, that's a positive turn. They were losing money for years before that.
So they're profitable now on an ROIC basis.
Yes, but compare it to peers. PepsiCo is around 16%. Monster Beverage, an exceptional 25%.
So Celsius still has a way to go to catch up on efficiency.
Definitely. They really need to improve that ROIC to justify the kind of premium valuation the market is giving them.
All right, now let's dive into Chapter 3. Financial analysis. Key metrics first. Market cap, the total value of the company. As of July 18, 2025, Celsius's market cap is somewhere between $11.5 and $12.0 billion. Puts it firmly in the large cap category.
Big company now.
Definitely. Now, revenue growth trends over the past 5 years. This tells quite a dramatic story, like two different eras.
Go on.
From 2019 to 2023, growth was just phenomenal. Revenue skyrocketed from $75 million to $1.32 billion. That's a compound annual growth rate, CAGR, of over 100% year after year. Just explosive.
Triple-digit growth. Incredible.
But then, a sharp reversal. Full year 2024 revenue was $1.36 billion. That's only a 3% increase over 2023. Flat. basically.
Right now, from 100% plus to 3%, that's hitting the brakes hard.
Hard. And it gets worse. In Q1 2025, revenue was $329.3 million, which was actually a 7% decline compared to Q1 2024, year-over-year decline.
Ouch, negative growth now. Yeah, and this data really captures the central tension here. You need to understand this dramatic shift from hypergrowth to suddenly shrinking year over year. It's critical.
Absolutely central to the investment case today.
Okay, profit margins. Some interesting dynamics here. Gross margin profit per can actually improve commendably. It hit 52.3% in Q1 2025, up from 48% in 2023.
What's driving that improvement?
They attribute it mostly to sourcing efficiencies and lower freight costs, so better cost management on the production side.
Okay, that's positive.
But operating and net margins are much more volatile. Net income actually declined from $227 million in 2023 down to $145 million in 2024.
So costs below the gross margin line are eating into profits.
Exactly. They even had a net loss in Q4 2024. Why? A massive 73% surge in SG&A selling, general, and administrative expenses, mostly due to legal costs, like that Florida judgment and restructuring costs.
Right. So profitability is recent, but it's definitely not stable or predictable yet.
Not at all. What about free cash flow generation? Over the past 5 years, for a high-growth company like Celsius it's pretty common for cash flow to lag net income because they're pouring money back into the business.
Reinvesting heavily.
Right. Long-term sustainability, though, really depends on eventually generating consistent free cash flow that exceeds net income. We're not quite there yet. Financial stability. Well, they don't have a long history of consistent earnings. As we noted, they actually lost money consistently from 2014 to 2018, only hit full-year profitability in 2019.
And that decline in 2024 profit really underscores that it's not yet stable.
Exactly. But it's not all bad news on the balance sheet. Celsius actually has a strong financial position in some ways.
Okay. Like what?
Low leverage. They don't have a lot of debt, and they have a substantial cash balance, almost $1 billion, $977 million, as of Q1 2025.
It's a good cushion.
And their current ratio, which measures ability to pay short-term bills, is exceptionally strong, $1.4 billion in current assets versus current liabilities. So high liquidity, low short-term distress risk.
Okay, so the balance sheet looks solid, even if profitability is shaky.
Right. And as we said, dividend stability and growth, not applicable. They don't pay one.
So, given this whole financial picture, the slowing growth, the volatile profits, but the strong balance sheet, it really brings up that key question again. Why are investors paying such a premium for this stock?
That is the multi-billion-dollar question, isn't it? Let's talk relative valuation. Celsius's price-to-earnings ratio, the PE, how many years of current earnings investors pay per share?
And the number is?
Shockingly high. Depending on how you calculate it, it's in a wide range from about 94 times earnings up to maybe 139 times earnings.
Wow. 94 to 139 times.
Yeah. Now contrast that sharply with the main competitors.
Yeah.
Monster Beverage, around 39 times earnings. PepsiCo, around 20 times. Coca-Cola, around 28 times.
So investors are paying maybe 3 to 5 times more per dollar of Celsius earnings than they are for Monster or Coke or Pepsi earnings.
Exactly. The market is essentially pricing Celsius based on expectations of extraordinary future growth, not its current reality. It's a massive bet on the future.
A future that looks very different from the recent past.
Indeed. Now, for intrinsic valuation, we use a discounted cash flow, or DCF, model. This tries to estimate a company's fundamental worth by projecting future cash flows and discounting them back to today's value.
Requires making assumptions, of course.
Yeah.
Growth, profitability, risk.
Big assumptions. And educational DCF models for Celsius suggest a pretty wide intrinsic value range, somewhere between $37.66 and $51.60 per share.
Okay, so quite a spread.
And our own conservative analysis actually suggests an intrinsic value below the current share price of $44.43. To get a value justifying today's price, you need to make really optimistic assumptions.
Assumptions that might be hard to square with the recent slowdown.
Exactly. Key assumptions for a DCF here would include a revenue growth rate. Well, it has to be moderate initially, factoring in Alani Nu and international expansion, but then it has to gradually slow down to the overall energy drink market growth around 7.5%. You definitely can't plug in those old 100% plus rates.
Right, need realistic assumptions.
The discount rate, or WACC, needs to be higher because Celsius's stock is more volatile than the market. Its beta is around 1.45.
Higher risk, higher discount rate.
And then you assume a terminal value, long-term growth, maybe around 2.5%.
So, pulling all this financial analysis together, What's the big takeaway?
I think the most salient finding, the thing that really jumps out, is the profound disconnect between Celsius's current performance and its market valuation.
Yeah. Negative revenue growth, declining profitability, but a PE near 100.
It just doesn't square up easily. That valuation implies flawless execution, rapid growth restarting immediately, things not supported by the recent results at all.
It creates a really precarious situation for investors, doesn't it? There's
Yeah.
virtually no margin of safety, no room for error if things don't go perfectly according to that super optimistic script.
Perfectly put. Precarious is the word. Okay, let's transition now into Chapter 4, market sentiment. How is the market actually viewing Celsius right now?
Well, looking at Wall Street analysts, the consensus among 14 of them is a moderate buy. Okay, so generally positive, but not overwhelmingly so.
Right. And their average one-year price target is around $46 to $47. From the current $44.43, that's only about 6-7% upside potential. Pretty limited.
And is there agreement among analysts?
Not really. There's a wide dispersion in those targets, from a low of $30 all the way up to nearly $61. That tells you there's a significant lack of consensus, a lot of uncertainty.
Analysts seem divided too.
Yeah, and the general media tone reflects this. It's very mixed. You see positive stories about Alani Nu's potential or international growth.
But also negative commentary.
Definitely. Highlighting the sharp revenue slowdown, the market share stumbles, the PepsiCo dependency, and of course, that persistently high valuation. It's truly a battleground stock.
Lots of debate, lots of strong opinions on both sides.
Exactly. Now, let's unpack another really telling indicator. Short interest.
The percentage of shares being bet against the company.
Precisely. And for CELH, it's exceptionally high, somewhere between 13.2% and 16.7% of the float, the shares available for public trading.
How does that compare to peers?
Significantly higher. The peer average is around 6.4%. So there's a lot more capital betting that Celsius's stock price will go down compared to its competitors.
That's a strong bearish signal from a segment of the market.
It is. And the days to cover how long it would take shorts to buy back all their borrowed shares is about 3.3 days. That reflects some real conviction among those bearish investors.
Okay, so significant short interest. What about technicals, moving averages?
Good question. From a technical analysis perspective, Celsius is currently trading almost directly on top of its 50-day simple moving average. The stock is at $44.43. The average is somewhere between $41.34 and $44.88.
Right on the line. What does that suggest?
It suggests a critical inflection point. A lot of uncertainty about the short-term trend. Could break either way.
And the longer-term trend, the 200-day average.
Well, the stock is trading well above the lower end of its 200-day range. $32.66, but it's actually testing the upper end right now, around $44.46.
So the long-term uptrend is technically still intact, but it's under pressure.
Exactly. It's holding on, but barely. A break below that 200-day moving average would be seen as a significant bearish signal by many technical traders.
So technically precarious as well.
Seems that way.
Right.
All right, moving into Chapter 5. Ownership structure. Understanding who owns the stock helps you understand who holds the power and what their actions might signal. First off, institutional ownership is high. Between 61% and maybe 72% of outstanding shares are held by about 918 institutional investors. Think big names like AllianceBernstein, BlackRock, Vanguard.
So the big money managers are heavily involved.
They are, and the ownership is relatively concentrated. The top 25 large shareholders own over 68% of the company.
Meaning their buying or selling decisions can really move the needle on the stock price.
Absolutely. Now, what about insiders? Management, directors, founders?
Do they own much?
Insiders themselves own about 11.9%, and related private companies, including the DeSantis estate, hold another 15.5%. So yes, significant insider stakes.
Skin in the game, so to speak.
Yes, but here's where it gets really telling. You have to look at recent insider transactions. The data shows an overwhelming pattern of selling.
Oh, how overwhelming.
Over the past 12 months, insiders sold a staggering 27.2 million shares and purchased only about 311,000.
Wow, that's a net disposition, selling, of over 26.9 million shares.
Huge imbalance. Specific examples. CEO John Fieldly sold over 130,000 shares just last month, June 2025. The DeSantis estate sold hundreds of thousands in July 2025.
Now, some sales might be for diversification, tax planning, contract settlements.
True, some sales might have routine explanations, but the sheer volume and the consistency of the selling across multiple insiders, That's a significant red flag.
Yeah, it's particularly insightful. While you can explain away individual sales, a consistent, heavy pattern of selling by the people who know the business most intimately, it strongly suggests they're actively reducing their financial exposure,
They're voting with their wallets.
or lack thereof in this case. They're cashing out.
It's a clear signal you really can't ignore. And finally, on ownership. That concentration we mentioned, particularly large individual stakes like the DeSantis estate or Hui Xuanchao, who owns nearly 9%, adds a specific risk.
How so?
Well, if one of these large holders decides to liquidate a big chunk of their position, even for reasons totally unrelated to Celsius's performance, like estate planning or whatever.
The sheer volume of shares hitting the market could push the price down suddenly.
Exactly. It's called overhang risk.
Got it. So ownership structure reveals concentration and heavy insider selling.
That's the takeaway. Okay, next up, Chapter 6, Risk Assessment. This is crucial for your complete understanding of the investment landscape here. Let's use a SWOT framework. Strengths, weaknesses, opportunities, threats. Starting with strengths, we've touched on these. Powerful life-fit brand identity. Demonstrated growth and scale, it is a billion-dollar revenue company now. That strategic PepsiCo distribution partnership is huge. And the expanded brand portfolio with Alani Nu.
Solid strengths, especially the brand and distribution.
Agreed. Now, weaknesses. Extreme customer concentration, PepsiCo being nearly 60% of revenue, is a major vulnerability. The precarious valuation, that PE near 100x, implies unsustainable growth.
Leaving no room for error.
Right. Profitability is inconsistent and fragile, only recently achieved, and already volatile. And that huge Alani Nu deal brings significant acquisition and integration risk. Merging big companies is never easy.
All significant weaknesses.
Okay, opportunities. International expansion is a big one. Currently only about 7% of revenue, but it was growing fast, 41% year over year in Q1 2025 before the overall slowdown.
Huge potential runway if they can execute.
Definitely. There are also portfolio synergies leveraging Celsius and Alani Nu together, maybe pushing Alani Nu through PepsiCo's network eventually. Favorable market tailwinds like health consciousness are still there, and potential for further product innovation maybe into cognitive enhancement, gaming drinks, who knows?
Lots of avenues for potential future growth.
If they can navigate the threats. Which brings us to threats. Intense and enduring competition. Red Bull, Monster, Pepsi, Coke, plus new entrants constantly popping up.
It's a brutal market.
It is. Shifting consumer tastes, the beverage industry is notorious for fads. What's hot today might be forgotten tomorrow. Heightened regulatory risk regarding caffeine, sugar, marketing, that hangs over the whole sector. And those ongoing lawsuits against management we discussed.
A minefield of potential problems.
And we need to talk about macroeconomic factors too. Inflation. If input costs, aluminum cans, ingredients, transport keep rising and they can't pass it all onto consumers.
That pressures their gross margins, which were just improving.
Exactly. And higher interest rates could dampen consumer spending on discretionary items like premium energy drinks and also increase the cost of borrowing for future investments.
Standard macro risks.
Okay.
There's a new specific one too, right? The tariffs.
Yes. Let's bring the expert in on this. This seems like a significant new external challenge.
It really is. If we connect this to the bigger picture, a major new headwind comes from the aggressive U.S. tariff structure that was implemented in 2025. This could directly hit Celsius's profitability.
Okay, break that down for us. What are these tariffs?
Well, there's a universal 10% tariff on basically all imported goods. On top of that, there are additional higher tariffs specifically on goods from China, 34%, and the European Union, 20%.
Wow. How does that impact Celsius specifically?
Think about their packaging, aluminum cans. Historical tariffs on imported aluminum already caused beverage can costs to jump 15–20% in the past. These new, broader tariffs represent another direct and potentially significant hit to Celsius's cost of goods sold.
So higher can costs eating into that gross margin.
Exactly. And it's not just cans. The universal tariffs will also likely increase the cost for any imported ingredients they use in their drinks.
Double whammy on costs.
And there's another angle, retaliatory tariffs. If other countries retaliate against these U.S. tariffs,
it could make Celsius products more expensive overseas, hindering that international expansion they're counting on.
Precisely. It could slow down that key growth engine just as they're trying to ramp it up.
So these tariffs are a really good deal then?
I think so. They pose a direct challenge to Celsius's recently expanding gross margin, introducing significant uncertainty and risk to future profitability. It's like adding external cost pressure right when internal growth is already decelerating. A tough combination.
A very tough combination. Okay, so with all these factors swirling the business, management, financials, market view, ownership, risks, and now these tariffs, let's try to bring it all together in Chapter 7. Conclusion.
Yep.
Let's synthesize our findings. Start with the positive side, the bull case. Why might someone be optimistic about Celsius?
Well, the investment case rests on that powerful, resonant brand identity, the Life Fit ethos. They have a formidable #3 market position in the U.S., 16.2% pro forma share with Alani Nu included.
And that PepsiCo partnership.
Absolutely key. Provides an unrivaled distribution network, a significant competitive moat, especially against smaller players. Plus, there's that vast, largely untapped international growth runway, still less than 10% of revenue. And they've shown a capacity for innovation and strategic expansion, like the Alani Nu deal.
Okay, strong brand, great distribution, international potential, innovation capacity. That's
Right.
the bull case. Now, flip side, the bear case. Why the caution?
First and foremost, that unsustainable valuation. The PE near 100x seems completely disconnected from peers and, more importantly, from their recent performance.
Which shows that sharp deceleration, even a year-over-year decline in quarterly revenue recently.
Exactly. Then there's the critical concentration risk being so heavily reliant on PepsiCo's inventory decisions. The competitive moat, while strong against small players, is permeable to big ones and requires constant spending due to low consumer switching costs.
Don't forget the insider selling.
Right. Heavy insider selling by top executives is rarely a good sign. And now, these new external cost pressures from the geopolitical tariffs add another layer of risk to profitability and expansion.
Okay, so valuation disconnect, growth slowdown, PepsiCo risk, permeable moat, insider selling, tariff headwinds. That's a hefty bear case. Let's quickly restate the valuation summary. Our analysis suggests the intrinsic value is likely below the current market price of $44.43.
DCF models point to a range roughly between $37 and $52, give or take.
Meaning, to justify today's price, you need highly optimistic assumptions that are really challenged by the recent performance slowdown and these new cost pressures. There's little to no margin of safety.
The cushion just isn't there at this price, given the risks.
So what does this all mean for you, the listener? Celsius Holdings, well, it's clearly at a critical juncture. It's a company with admirable strengths, great brand, powerful distribution, no denying that.
Thought it.
But the market price seems to have run far, far ahead of its underlying fundamentals and, frankly, its realistic growth prospects given the recent data.
The current price appears to be baking in a future of absolutely flawless execution, almost ignoring the recent slowdowns, the integration challenges with Alani Nu, and these new tariff risks.
Yeah. So from a value investor's perspective, that combination, precarious valuation, decelerating growth, significant insider selling, and new external headwinds, it creates a risk profile that looks decidedly unfavorable right now.
The risk seems to outweigh the potential reward at this particular price point.
So, the bottom line from our deep dive. While Celsius makes a popular product, the stock itself appears, at best, fully valued. The risk-reward profile seems skewed to the downside. And here's a final thought to leave you with. Perhaps the real question isn't just about Celsius's future growth, but whether the market itself has become sort of addicted to that high-octane growth story, potentially overlooking the very real possibility of a fizzle as the company faces these significant new challenges. Something to ponder as you look at your own investments. If you found this deep dive valuable, we'd really appreciate it if you'd like and subscribe to the SNOC Analytics AI YouTube channel. And remember, members paying just $4.99 a month get priority deep dives on tickers they request. Plus, over the next few months, we're actually covering all of the S&P 500 stocks, and members get exclusive priority access to those.
Or if you just want a one-off deep dive on a specific stock, you can always drop us a super thanks on YouTube.
That works too.
And finally, the crucial disclaimer. This analysis was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice. Always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Thanks for diving deep with us today. Until next time.